This week, I sold almost $50,000 worth of stocks, and in this video, I'm going to explain to you why as I reveal my $438 odd thousand Canadian dividend stock portfolio, my ideas, my plans for the future, and I need your opinion on it. But before we go down that rabbit hole, before we dive into the portfolio, the cash position, I really just want to talk about where the market sits today and what is going on, because I do have some regrets, some remorse. This market is purely summed up by stocks rise as investors await debt deal and AI hype lifts tech. Obviously, there's been a lot of concern over the debt ceiling. That seems to be getting kind of resolved, and AI is like the new big hype thing. I mean, you remember in 2018, it was 2019 period was the MJ markets. And then it was crypto, NFTs, SPACs, all that stuff exploding. Now we're into this new phase of just AI insanity because look at the market today. My God, Tesla's up 6%. VOO's up 1.5% to a new all-time high for the year. Just the year, not an all-time high forever yet. But we got SCHD doing great here. Palantir going to the moon again. I mean, Meta's doing great. TSM, all these stocks. I mean, TSM is my biggest regret. And I really think, I'll explain why, but I think NVIDIA, could you imagine that this entire pump here is purely based off guidance? Like the next quarterly guidance, it's up 26%. It's one of the biggest gains, like from a market capitalization standpoint in history. I mean, we're talking about a couple $100 billion pretty much within a day, which is just astounding. And it's none of it's based on bottom line right now. It's all based on future expectations, which is just mind-blowing. And there's a big regret that I had because I had TSM, right? TSM's up a lot. I sold out of this thing. I made a good few $1,000s on it buying it. I think my average cost was around $80. Got out of it in the mid to high 80s, closer to 90, and I just sold it purely based off the fundamentals. And this is not a fundamental market, folks. I mean, take a look, because the monthly revenue, and this is what I didn't think was happening for January, February, I was like, TSM's going to crush. The revenue is going to stay in a positive area this year because there's just so much demand for chips, and that's what we saw. And then out of nowhere, March, April, 15% decline year over year in revenues. And I was like, this isn't what I signed up for. I thought this company was going to outpace Apple and all these companies, and now it's just falling in line. So I took my shares out of the company. And that was a mistake because hype took it to the moon. And I've come to realize something in a market like this. Just pick stocks you love and buy them and cost average into them over the next 10, 20 years. That's all you can do, because in the short period of time, my bet on Taiwan was, Taiwan Semiconductors was for like 1 to 3 years. I barely made it 6 months into this because I just didn't expect it to start seeing slowing revenue. And let's talk about the Canadian side of the border here for that fact. I mean, look at Royal Bank. Everyone's terrified of the Canadian economy right now. A lot of Canadian stocks have sold off. I've been getting a lot of questions about it. Royal Bank posted earnings, and honestly, I didn't think they were that bad. We'll talk about it in a sec, but these are the sectors that I'm loving right now because honestly, go where the most hated aspect of the market is and come back to me in 1 to 2 years and tell me it was a mistake. I mean, like, can you just imagine these banking stocks that are yielding 4.5% to 6%, 7% on some of them? And they're like these cyclical lows, and it's all because they're just putting loan loss provisions aside. I mean, look at revenue here for Royal Bank. This time last year they did 11.2 billion. This quarter they did 13.5. On a year, on a 6-month trailing, 24 billion to 28 billion. Their net income is down because of loan loss provisions. We're seeing that with every bank. People are terrified of the economy. I don't think it's going to be as bad as people want it to be. Could be black swan event. Who the hell knows? I'm not going to gamble or speculate on it. But I mean, if you're looking for buying opportunities, I think that's where it currently exists. And honestly, I would stop presuming stocks are overvalued or undervalued based off current fundamentals. I mean, you can't short this stuff. You can't speculate into the future. Just cost average and call it a day. And just, I kind of like the Dave Ramsey style of thinking, where I kind of like the idea of 3 or 4 ETFs, growth and income, something like a broad-based index, globalized, and then just pick a handful of individual stocks. That's all you got to do. Take the stress out, because you'd be losing your marbles trying to predict this market. It's absolutely bananas. But taking a look at the positions I still hold, I did sell a huge percentage of VDY. I sold about 40,000 out of this company, and that's purely just because I'm going to explain in a moment actually. But I sold VDY over the last week. I took about a couple $1,000 loss on it. Not a real loss because of the dividends I've collected over the last year holding it, so it's kind of just flat. I didn't really make or lose money on it. SCHD, let's take a look at the year to date. One of the more hated ETFs. I'm still cost averaging into this. I'll be buying more next month with the dividends that I get. And then we got VOO, of course, one of my favorite ETFs that is now hitting a new high on the year. So year to date, I do think it just peaked, right? It's up 0.91%. So taking a look at these three ETFs that pretty much comprise my entire portfolio, out of a few, small investments in things like a Duro. I also have like some private placements that I hope come public at some point. But nonetheless, I'm down about $10,000. This isn't adjusted for today. It's probably up a little bit more, worth about $340,000, sitting on about $98,000 in after-tax cash. And why am I doing this? Why am I taking cash out? What's the plan? Well, I'm looking to buy a house sometime next year. I mentioned this. And a wise man, a lot of investors in Canada, these guys that have been around the block that are in their 50s, told me, hey, if you need cash in the next 1 to 3 years, don't put it in the stock market. And because I can get over 2% in a high interest savings account, I can put it in high interest saving vehicles. Like there's stocks that offer high interest savings account with no, market risk. There's GICs. I can easily get anywhere from 2 to 4%. So why take the risk in this market when I want to utilize this cash to buy a house at some point? So I did pull some cash out of my regular brokerage account where I held VDY. I didn't pull any money or cash out of my TFSAs or RSPs, but that leads me to this intriguing question that I want to ask you guys about. Would you sell out of your entire portfolio to have absolutely no mortgage? I mean, I'm 31 years old. I'm looking to buy a house next year with my fiance, and we have enough cash between us to pretty much outright own a house, which is, something that I'm very grateful for at my age. You want to compare yourself to the Graham Steffens and Meet Kevins, but hey, I'm not a multi-millionaire, but I could have a paid for house in my 30s. But then the debate is, or do you keep some invested? Because we were thinking about putting a 50% down payment. The numbers would become a little more feasible. It'd be less than renting at that point. But at the same time, if you could completely get the mortgage monkey off your back, pay absolutely no mortgage at a 5 or 6% interest rate. And again, if you're only going to make 8 to 10% off the market, is it really worth having a mortgage or having investments to try and compete with the mortgage? It's just the debate, because we could take my investments to zero, sell out of everything, pay a little bit extra tax on some of the gains of my corporation and putting it into my personal name, but then owning a house outright. It's a debate that I've been going back and forth, like this bipolar disorder in my head, because it's an intriguing thought, right? So I'd love to know what you guys think about that. My dividends are now down to about 11,106. This will bump up a lot more once I take a lot of this cash into high interest savings, because now I've got about 113,000 in VDY, 118 in VOO, and about 10 or 107,000 in SCHD. And we're going to talk about how the individual investments in each one of these ETFs are starting to overlap. And if you want to support the channel, you like the way my portfolio is tracked here, you can go over to portfoliospreadsheet.com. You can buy one of these spreadsheets, get one for each platform. Try it out. I really love the iCloud version. I also sell separately some personal finance spreadsheets, so you can kind of track your FIRE or pay attention to your income and expenses if you're kind of into being a little bit more fickle about, saving up money to even buy a house like I am. But let's talk about the overlap here. This has actually balanced the portfolio out a little bit, because I was really weighted on the Canadian side of the border, which again I was fine with. It brought in that extra dividend income, but we can see Royal Bank is now about 4.7% of the entire portfolio. Toronto Dominion's 3.8, Enbridge at 2.7. So these three positions make up a healthy chunk of just over 10%. Then we got Apple in here and Microsoft making up just under 5% of the entire portfolio. Canadian Natural Resources, Bank of Nova Scotia, Bank of Montreal, Suncor, BCE. So you're getting some of the telecom giants. We got Pepsi in here, which is the largest weighting in SCHD. We've got TC Energy, Coca-Cola, Merck & Company, Verizon, Canadian Imperial Bank, Chevron, Home Depot, AbbVie, Amgen. I love these companies. The farther we go down, we can see we got TELUS, Sun Life, Restaurant Brands. There's your Nvidia pumping to the moon, Pembina. You got Tesla in here. So you're getting exposure to basically the broader Canadian and US market. Now, from a sector exposure, I am giving myself a lot of risk here, which we're seeing in SCHD. We're seeing it in VDY just in this 1 year. If you zoom out, the performance chart is more in line with the S&P 500, but obviously financials at 27% and energy at 13%, both sectors that are getting hit pretty heavily right now. So probably a healthy thing to scale down VDY, but the tech sector 12.7. I want to just keep buying the S&P 500. I'm probably going to continue using dividends to cost average into the into VOO, because honestly, like I said, I'm not for or against dividends. I'll still be around $1,000 a month once I get all of that money put back into high interest savings. But again, I still like the idea of getting a little more exposure to tech. We got healthcare, obviously, industrials, consumer staples, communication services, and consumer discretionary making up the vast majority of it. But yeah, at this point, folks, I'm just kind of battering that idea in my head of where I want to be a year from now. And that's being in a position to obviously, get our lives together in our 30s here, and just trying to go about it in this really expensive market is rather confusing. So I'd love to know what you think. If you had the opportunity to outright own a home, would you sell all of your investments to kind of go, I wouldn't say start from scratch. You're giving up that passive income, but again, you're greatly reducing your overall expenses. And to be in my early 30s and do that, I can still reach financial independence by spending up to my 40s, the next 8 years, just living life, putting a lot of money away, having a comfortable place where if we want to have a family, we could do so as well. I don't know. I'd love to know what you think.